what's up, everybody? Wednesday, June 16th, my new podcast is out. I just posted it up, so check it out. The link is in the description right here below. Go listen to it. I think you'll like it. All right, conclusion of the Fed meeting today. There's a lot to unpack. Let me go over it, all right? Basically, no change in policy. They're going to continue to buy $120 billion a month in assets, and they're going to keep doing that until they think that the situation doesn't merit that anymore. And they're going to continue to do that despite the fact that their asset purchases are part of the reason that the banks are having all these problems with massive amounts of reserves on their balance sheets, money market funds having to park cash at the Fed, all the crazy machinations now that the Fed is having to do, like for example with reverse repos to temporarily relieve these situations. So, I think it gets back to what I said in my last video, that I think the Fed is deathly afraid to stop these asset purchases because they see that as some kind of stimulus and they're afraid to pull that back. Yet that activity is causing so much problems with the banks that the Fed has to engage in these special monetary operations, these reverse repos. It's just a mess. What they did do, and this is interesting because I think, we got a big move in the markets today. We had a move in stocks. We had a big move in the dollar up. Bonds went down. Gold went down. By the way, I sent out to all my subscribers, way before the meeting, I said, be prepared for a lot of volatility. And I said, stocks are going to go down. I told everyone to be prepared. But I'll discuss that in a minute. What they did was they raised interest on excess reserves by 0.05. It is now 0.15%. It was 0.1%. So when you figure $4 trillion in reserves, a 0.05 increase, that's pumping an extra $2 billion into the banks, basically free money, profit into the banks. And we're probably getting near the point where Treasury has drawn down its account to a level that, is going to be static now, maintained. All right, so we're probably coming closer to the end of these, massive reserve additions, notwithstanding the fact that the Fed is continuing to buy assets. I mean, it's crazy. Anyway, whatever. So I mentioned, the other thing that was in there was the dot plot. This is this kind of predictive model that the FOMC members, they say, well, when do you think we're going to raise interest rates? Prior to today's meeting, they didn't see a rate increase going all the way out to 2023, or maybe one rate increase. Now there was they see 2 rate increases in 2023. So I mean, look, so many things could happen between now and then. I don't even pay attention to that. And basically, I don't pay attention to monetary policy in the same way that most people, they're sitting on the edge of their chairs, white knuckle, oh my God, what's the Fed gonna do? I don't pay attention to that. I mean, for me, I understand what rate changes mean, okay? Those are price changes, okay? Those are fiscal operations, basically. When the Fed raises rates, the government is a net payer of interest. That, it's basically an increase in fiscal transfers. When it cuts rates, the opposite is true. And of course, it's a price setting function. When you raise rates, I've been through this a million times. You raise rates, you raise the general price level. When you lower rates, you lower the general price level. I mean, that's how I look at it. So I don't get all crazy. I mean, to me, the most important thing are the fiscal flows. I'm going to talk about that in a second. The other thing, yeah, I mentioned that they saw 2 rate increases now in 2023, and this little bump up in the interest on excess reserves that they're paying, this 0.05 increase, oh my God, right? It sent everything crazy. Like, people were freaking out, like this is a gigantic rate increase. The dollar went shooting up. Gold went crashing down. Okay, oil pulled back. Like, risk assets were coming down. Bonds went down. Bond yields went up. So everybody reacted like this was not just an immediate big rate increase, but it was a signal that now we're in the rate increase mode, which I don't think is so sure, okay? They didn't say they're going to raise rates. The dot plot said out in 2023, most members thought you'd get 2 rate increases. The only thing they did raise was that interest on excess reserves. Now, if you understand this through the lens of MMT, rate hikes, even small ones like this, the 0.05, that dollar rally, that's not going to last. I'm not saying it's turning around tomorrow, but you got to sell into that. That gold decline, because it is a tiny little, price adjustment upward. That gold decline, you got to buy. I'm not saying it's going to bounce right back up tomorrow, but you have to go against these moves. Number one, these are moves based on a total lack of understanding of what they truly mean, what monetary policy adjustments mean. And number two, they are, even if you didn't know that, even if you didn't know the MMT, understanding of that, and I shouldn't say the MMT understanding, but the true understanding of that, even if you didn't know, even if you were clueless on that, right? The very fact that it was so emotional on such a fractional, little, tiny adjustment. I mean, I love this. When you look at people behaving this way, I think I said this yesterday in my video, you don't need to know a lot. All you need to know is when people panic, when people freak out, when people behave so emotionally, I mean, that's your signal right there. That's what you go against. So the bond sell-off, you buy it. The dollar rally, you sell it. The gold sell-off, you buy it. Stocks, here's the thing. Fiscal flows. I've been talking about these cuts, these benefit cuts. So far, I'm not seeing too much. Now again, we're very early into this. This is the first week. Only 4 states started this. So I cannot definitively say there's a trend in place. Right now, actually I can't. I can say the trend in place is that fiscal flows are still very, very strong. And that's bullish for stocks. So I mean, might want to buy into this dip, but I need to give it, me personally, I need to give it a little bit more time. I want to see more of this data, and I'd like to see when more of these states start, cutting their benefits, what the impact is going to be. So that's basically what happened today. I mean, if you want me to broad brush it in one stroke, super highly emotional reaction on nothing in terms of a policy change. I'm talking nothing, really. Super high emotional reaction. That alone, at least me personally, I see something like that, I go against it every single time. Every single time. Just wait patiently. I mean, when I see people acting like that, they don't know what they're doing. They absolutely do not know what they're doing. They are just on a hair trigger. They're so emotional. They can't control their emotions. That is not a savvy, that's not something sophisticated or savvy or very insightful going on. I could be wrong, but I mean, I'll go against that every single time. That's all I'm saying. Anyway, don't forget, check out my podcast. The link is in the description below. And go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye.